Welcome to CMR Interviews by Jason Shapiro. In today's episode, Jason interviews Linda Raschke on having an edge in trading and the importance of data. To learn more about Jason and Linda, check the episode notes in the description.
Hello. Today is March 26, 2024. I'm Jason Shapiro with crowdandmarketreport.com. Today I have the pleasure of welcoming Linda Brandford Raschke, who is a legend in the trading and money management business. And we are going to have a conversation about trading and money management and anything else that falls into line here. I will start by saying, before I did this interview, Linda was nice enough to mail me her book, which is this thing right here. It's called Trading Sardines. And I read it, and it was awesome because it was such an easy read. She shared a lot of market and trading wisdom, as well as a lot of life wisdom, and some really fun stories about love, life, and trading. And I would recommend it to anybody. So on that note, Linda, welcome, and thanks for joining.
Thank you for having me, Jason. It's a real honor.
So I usually start with this very simple question. How do we make money over time trading the market?
Oh, well, let's just open up the whole can of worms right off the bat. How do we make money?
That's what we want to know, right? That's what we want to know.
You have to have some type of edge. That would be obvious in any game that you play, be it bridge or gambling or the markets. You need to have some type of statistical edge that may came from modeling, or it may come from an early arbitrage opportunity with new emerging markets. It might come from experience. Even experience is a form of an edge, but you do have to have some sort of edge. And then you need to apply that consistently. So over time, it's just a big numbers game. If I make 1,000 trades and I have N edge, I will have a positive expectation. And the more trades you can make with that type of thesis, the closer you come to a guaranteed profit. And of course, you always need to have that little money management algorithm in the background. But I think that you can either be very systematic and have it hard-coded in your brain or your system, or just through experience, you might know how to manage the bottom line a little bit more appropriately. So, I think that the initial problem is getting that experience, or when people first start trading out, it's like trying on hats. You have to try this style. Is it going to work for you? Maybe you try that for 3 months. Maybe we try spreading. Maybe we try options. Maybe we try seasonal programs. Maybe we try commitment of traders reports, but you can't arrive and start to learn the nuances of something until you have explored many different styles if you are new to the markets. And that whole process can take a minimum of 3 to 5 years. So just like anything, it's like playing, poker and capital preservation until you get that experience under your belt.
Excellent advice. I mean, I can't just start trading today and start making money right away and just go for it.
You bought those GameStop options a couple of years ago. You never know, huh? Did you see that movie, by the way? Oh, I'm not supposed to ask you questions. It was fun.
I did not see the
Dumb
movie.
Money. Yeah,
I watched it in live time.
Yes.
Which I thought was enough. But
Okay.
Maybe, was the movie good? Maybe I should see it. I don't know.
You should, for history's sake. It wouldn't make sense if you weren't a trader, but you'll get it.
I didn't see that movie about the penny stocks with Leonardo DiCaprio for a lot of years because I knew people when I was in college that were in the penny stock game, and the whole thing made me sick.
Wolf of Wall Street?
Yeah, so I refused to watch that movie for many years. And then once I did, it was actually hilarious. Yeah, it was actually hilarious. So now I watch it all the time. But sometimes I just don't want to watch something that I kind of lived in live time. Anyway, okay, so you need to have an edge. And to develop an edge is going to take you time. What are the things we're looking for in that edge? And I'm not telling you, I don't need you to tell me, oh, well, the edges, you trade when the 5-day moving average crosses the 25-day. What do we need to look for in that edge?
In a perfect world, okay, I'll start off with a perfect world and then we'll deviate from there. In a perfect world, you need something that's durable and robust, okay? In other words, not optimized, will hold up over time. And for example, with my trading career, when I started off trading, I was in the floor and equity options on the Pacific Coast Stock Exchange, and it was a little bit like the wild frontier. We did not have computers. We didn't have the programs that keep all the options in line. So there was a lot of lucrative opportunity for those first couple years until it slowly got arbed out and everything got computerized. But, I've seen that time and time again with many things in the markets. It's you find something, and if you find it, other people can find it as well. And eventually it has what we'll call a half-life, with a system. A half-life, and it'll start to lose its effectiveness. Now, that's not true with everything. For example, you could take chart formations, a gorgeous weekly chart formation, which now has a lower frequency of occurrence, so everything's a trade-off. On the flip side of that, as the markets have become more crowded with different market participants, you have an increase in the noise level, which means an increase in false breakouts and so forth. So, everything's this sort of balancing act and trade-off, but ultimately you do want a style, I will say, an approach or a methodology that will last over time.
And to develop that style and that methodology, it seems like trial and error is really the best way to go.
Trial and error goes a long ways. That's with, look at medicine and biochemistry and physics. So much of what we've learned through the ages has been trial and error, and then freak chance, you stumble across something like penicillin. So there is a little bit of that, but there's also more than that. There's some savvy with pattern recognition. There's some savvy as to what we can do, what we cannot do. For example, with neural networks or artificial intelligence, which is so in vogue right now, they're only as good as what we train them on. Some people have a better temperament for risk taking, because ultimately, if you have not been in the markets for a long period of time, it doesn't matter whether you have an edge or not. You're going to be your own worst enemy, just with your emotions, until you learn to desensitize and get a very thick skin and so forth. So a lot of this game is just being able to stay in the game. As with anything, you're going to go to college, you're going to go to 4 years medical school, you're going to do 2 to 3 years residency. There is a big time period there before you start to get to that point where you can make the big bucks. And that's just with more. I'm saying that in the light of the retail type of the side of the business, because there's opportunity for some quants that are very sophisticated. I know some friends that are doing really interesting work, but it's a different science, if you will. So even, the most successful fund in history, everybody likes to look at Jim Simmons and his medallion fund, right? It's not that he's a trader. It's just that he had the most amazing, insane infrastructure network, that nobody else would be able to replicate. And what people don't understand with his particular fund, I don't know the stats now. I knew the stats 20, 30, 40 years ago, because I had clients that had monies with him. His average holding time was under 24 hours. So it wasn't like putting on big bets. It's just that they worked every market in the world, milliseconds at times, every single edge that could be. And, that is not possible for somebody like you or me. It just takes this insane amount of infrastructure and technicians and engineers to keep everything going. So we're talking about a different type of business here.
There's something I like to say a lot to people, which is you have to trade you. Would you agree
And
with
you
that?
know what? If you don't know who you are, the markets are a very expensive place to find out.
I have that written down here. I have about 10 quotes from your book written down here, and
All
that's
right.
one of them. So you just covered one of my quotes. Thank you.
Okay.
But being that, like, a lot of people, it's funny. I sat on a panel a few months ago, and we were talking about back testing and all this stuff. And somebody in the audience raised their hand and said, I don't know how to program, and I don't have back testing software, so I can't do that stuff. And one of the guys I was on the panel with said, so what you're telling me is you want to make money trading the markets. You just don't want to do the work that's necessary to make money in the markets, which I thought was a little harsh, but was absolutely true. I don't know how to program, but you get a trade station and you hire somebody for $50 an hour, quite frankly, and you can get pretty far. And if you actually take a little time programming something like TradeStation, it's very simple. It's all just a question of how much you want it, I think, And, and
I for the first really 10 years of my career, I did everything by hand. And I would print off charts and I would go by hand and I would calculate the variance for every single trade. And I learned more by doing that and seeing the times where it didn't work. And the problem with back testing, it's great for overall modeling and giving you an initial idea. And but the problem is that you're lumping so much data together, you're missing the skew. And the problem is that, I mean, with the markets, you have to understand that the skew is where the edge is. In other words, those fat tails. And so when you lump, say, for example, statistical testing with a sample size of 500, it wipes all that out and everything cancels each other out. And you'll miss those fine little nuances. And that's really about what the market is about to me, is that there's that skew. That's what offers the fat opportunity here. And it takes a lot of time to recognize that, because our humanness, we want to buy wholesale, sell retail, that type of stuff. And we're always looking for that arbitrage or that reversion to the mean type of thing, just subconsciously. If you see a car that's marked up too high, you're going to wait till it comes down, that type of thing. But what the markets do is they impart incredible information to us when these relationships get out of line, and they get out of line for a very definitive reason. And so it's hard for us to understand as humans because we don't see enough of that. We don't have enough sample size to really understand what's going on. But if you have a banded type of relationship and something starts to push outside that band, okay, there's a very strong reason why, and you generally want to go with that. And that's very difficult for people to get their hands around that, just like you've learned now by watching the Commitment of Traders reports, that just because it gets extreme, sometimes when it gets so extreme, you actually want to be positioned in the direction of that because there's something crazy going on there. And of course, eventually everything does a little bit of reaction in the opposite direction. But, so I wrote a book many years ago, and it was with Larry Connors, and the name of that book was Street Smarts. And so there definitely is a little bit of street smarts when it comes to the markets. It's not necessarily about having that master's degree in applied mathematics or, something that would allow you to have these incredible programming skills, which are of value for certain hedge funds or, quant shops that do that. But for the individual, I don't think it's necessary. I really don't think you have to do that. I think what happens is that, especially with electronic trading, it's so easy just to click that mouse. And it's very difficult for most people to have the patience and be very discriminating in waiting for the opportunities where, not to be cliche, because it did get to be a very cliche word in the last couple of years, that asymmetrical opportunity, or that high win rate. But the good opportunities just don't come along as often as people might think.
it's a fact, and it speaks to discipline, which to me is the hardest thing in the world. You can have the greatest system in the world if you're not disciplined over time. Even the greatest system in the world is going to have losing trades and get things wrong, and sometimes get things very wrong. And if you're not disciplined, you're doomed. That's what I believe. I think discipline is the single most important thing in this game. I don't care how you trade, and I think you'd probably agree with that.
I hate that word. I'm sorry.
Well, To me, that's
You know
that's
what it
everything.
is? It's like I like phrasing it as having a process. Because if you have a process, you're not putting yourself at the mercy of being disciplined or
Well,
undisciplined or doing
if you
impulsive
stay
things.
disciplined to that process.
Well, there, okay. All right. We're doing semantics here. But
You
yeah,
follow what
having
I
a
mean, though?
process so that it's
I see
almost
people all the
habit.
time. They have a process,
Mhm.
but then they don't stay disciplined to it. Okay, I'm going to get in here. I'm going to stop here. The stop comes. It's like, well, I'm going to let it drive for another day. Well, you know what I mean? It's like,
They probably haven't gone through that learning curve yet,
no,
though.
they will.
They're still, newer in the game. So,
No,
and
that's
that's
right.
why
They will.
it is definitely a game of attrition because, you can't have so many people winning at this game. I hate to say it, it's, not that every market is a zero sum type of game. That's not true either. But you are competing in an arena with major money that has exceptional execution skills. It's all automated and they are going to beat you to it. You can't leave yourself at the mercy of, oh, I'm going to get out if it hits this point. No, put your stop in. If you get hit, you can always get back in, so yes.
Fact. The first things that I wrote down from your book, some of these quotes, trade in the direction of the aberration. And you've mentioned this a few times in the book. Okay. And I love it because trade in the direction of the aberration. The market is never too high to buy or too low to sell. When something moves beyond its historical boundaries, there's a strong reason why, which is what you were just saying. A trader should be positioned in the direction of the aberration. I believe in this so much. This is what triggers pretty much every one of my trades is when a market does something that it's not supposed to do. I go with the market and not with what the supposed to do thing is. And I think that's an important point. I don't know if you want to expand on that. You might have done that a little bit already.
I'll just give you one example that's sort of a different dimension. And I did a lot of work with Steve Moore and Moore Research Center back in the early 90s. And I learned a lot about seasonals and the statistics behind them. And Steve's run this stuff for like 30 plus 40 years. He's probably, I think, the best in the business that does it, Moore Research Center. But you can look at a seasonal that goes back, say, 20 years or just say 18 years. And let's say it's seasonals are very much like an actuarial table. There's a window. It's not necessarily timing sensitive on either end, but there's a window where you would see a positive expectation. And so we can say, okay, the market rallied during this month, 15 out of the last 18 years, which is not a high sample size. So that means that on a walk forward basis, even though it was 85% win rate in the past, going forward, it might only be a 60% win rate. But now do that across a portfolio of 20 different markets and names. So it's all a numbers game. But here's what Steve taught me was that a failed seasonal often ends up being an even bigger trade than the actual seasonal. Okay, so there's a very strong reason as to why that seasonal fails. And so, we can't afford to get stubborn on these things. And you do have to have a cutoff by which you can say, this system is no longer working. This seasonal is not catching. This XYZ may, be the case. So that would be an example there. Just having a failed seasonal could be a bigger win in the opposite direction.
Yeah, I like it. Something really, things don't work all the time. And again, a lot of times when they don't work, it's an even better signal it's going to work the other way.
There you go. There's always a reason
So stop
why.
being stubborn.
Mhm.
It appears to me from your book that, and you talked about this earlier, about things give you an opportunity and they get arbed out. Tell me if I'm wrong, but it appears you've traded very many different things over the years. Maybe you used to do this and that worked for a while. And then it stopped working because maybe it got arbed out. So you continued to do research. You found this. You started doing this. And that worked for a while. And then it stopped working and you did research and you moved on to this. Is that correct?
Yes and no. I started off in the equity options, which was very much a strategic type of game. It's not like you're in the futures pits with the S&Ps and everybody going totally, crazy all day long. Although we did have green mail and black mail and some craziness in the pits, back in the 80s. But yes, the edge and the options did get arbed out. So everything was pretty much right in line. I don't trade crypto. I don't trade Forex. I mean, I trade the currency futures. I love the currency futures, but there's really no advantage for me to trade Forex versus the currency futures. I would much rather trade the currency futures where I can buy on bid, sell on offer, that type of thing, and use them on my execution platform with the same trade management tools or so forth that I do with everything else. I don't have to have several separate accounts. So I have traded stocks on and off, for like 30, 40 years. And I'll be brutally honest. It's like I find that I get more bang for my buck in the futures because of the leverage and it's so much easier to move size going in and out, with the S&Ps, one mouse click, you can do a couple hundred. And with stocks, you can't really do that. It's a different type of execution feel to it. And it's a little bit more capital intensive, at least for the way that I trade. So I pretty much stick to futures, and I've traded Eurex, the JGBs, the Italian bonds. I mean, I've traded futures all over the world, but now I pretty much just stick to the most liquid domestic futures markets. And trust me, that's enough to get into trouble.
It certainly is.
Mhm.
Again, I'm going to quotes from your book. These are some of my favorite ones. It's hard to muster the necessary confidence in a system unless you develop it yourself. And this is something that has come to my attention since I've started this Discord page and newsletter type thing. Because I find we started this thing with the idea of helping people to understand the bigger picture of what it takes to be successful in trading, not to copy trade Jason Shapiro. Okay. And I do put my trades on there because I want people to see what I'm doing, and therefore the discipline that I'm using and my stop losses and my risk management, so that they can see that that is the more important thing. But what I find is a lot of people copy the trades, and I beg them not to, for this very reason that you mentioned in the book. If you didn't develop this yourself, you're not going to have the confidence in it. I've been trading the way that I've been trading for over 20 years. I go through a losing period. I know that that's part of it. I have all my statistics, so I don't say, oh, those last 3 trades stunk, I'm not going to take the next one. I know how important it is for me to take the next one, because the next one may very well be the big one, right? So yeah, did you want to expand on that a little bit? The fact that you really need to develop your own thing and not,
Well, sure. Everybody has different temperaments, and some people are more nervous and need a little bit more. Some people can take heat, like I can take a ridiculous amount of heat, but that might not be the case with everybody, and it might not be a good thing either. I'm also very pro risk. I take a lot of risk and it doesn't bother me. It's gotten me into trouble in the past. I'm very much leap and then look, and assess. But the opportunity comes, I want to get it on, and then I can evaluate sometimes. I will say that even though I do so much crazy modeling, and I always have, and I've always hired people that have been full-time for my hedge fund that did all the number grinding for me. My real forte is that I'm just an exceptional tape reader. And that probably came from my years of standing on the floor when we didn't have charts. I didn't have computers. I didn't have software, where I could see these things. But there's a certain way that a market will trade when there's an increase in interest and an increase in volume and an activity. And I don't need to plot the volume on the chart. I'm usually looking at the my quote board, so I'm trading off of the little net change is pretty much what I watch, but I do it across a basket. So it's a very holistic type of dynamic markets to me. I mean, I watch the stocks, I watch the currencies, the metals, the crude, all these types of things. But I'm kind of watching the net change, and I can see when something's going plus or minus. And I've usually done my homework the night before that says, okay, if this dips below the previous day's low and starts to come back up, I'm going to get long. But I use a lot of discretion on entries. I'll use a little bit more systematic approach on exits. And I've pretty much categorized, my approach to exit for small target, which is if you're scalping or day trading on the S&Ps 80% of the time, you want to just play for a small target because they're very noisy markets. So if a market is going through a consolidation period, or market profile terms would say bracketing market, you want to play for a smaller target, pretty much, a mean reversion type of thing. If it's just starting to get some legs, then you can reach for a larger target. And then there are, about 6 to 7 structured categories that I have where I would trail a stop. And that is maybe 30% of the time are there cases where you can go into the marketplace and trail a stop and do better than playing for a small target or a large target. I tend not to scale out, so I'm pretty much all in, all out. That's just what works for me. I find that people, when they scale out, often it's more to satisfy that psychological need, but it does alter the numbers. So if you want to do that for yourself, that's fine, but just recognize that that's why you're doing it, to scratch that little mental itch that you might have. So I like to do a little bit of everything. If I'm day trading the S&Ps, I might only make 1 or 2 trades a day, and then I'll be looking for my, positions that I can put in one day, out the next day, or hold for 2 or 3 days. And then those opportunities where we can hold a trade for, say, 2 weeks, without really taking much heat. Maybe you get 7 of those per year per market, so it's identifying the pre-existing conditions and then understanding that I might only capture, if I have 120 trades, I might only capture 60% of those trades. You see, it's and then if you have a system that says you should make N%, you're doing great if you capture 80% of that, because it's pretty hard to, for numerous reasons, psychological execution, software, hardware, time of day, all kinds of things, why people will 99% of the time underperform a quote system, unless it is 100% automated and systematic. And even then you've got can of worms for a smaller individual that doesn't have that sophisticated reconciliation going on in the background and so forth. It's a whole different business, though.
I think it's an interesting comment. If that's what you're doing, you were talking about the scaling out thing, that's fine. Just recognize why you're doing it. And I love that, because that's how I feel about all of this. I think this whole game is a battle against yourself. And recognizing why you're doing things, to me, is the most important thing you can do, right? Finding and being honest about your own biases so that you can overcome them, is to me the most important thing that you can do, and what people have the most trouble doing, not just in trading, but in life. I mean, I see it all the time with almost everybody I talk to, these biases that they can't get over, be it, and I don't want to get into it, but be it political, be it religious, be it whatever, the biases just overtake any kind of ability to think in an open-minded way. And that's fine in life if that's what you want to do. You're not hurting anybody necessarily, but in trading, you're going to lose money. So, to me, that's the most important thing to me. I don't know how you feel, but and it goes back to the whole discipline argument as well. But to me, it's psychological discipline,
What I would do would be anybody that maybe's been in the game for less than 10 years, maybe, a little bit more than 3 years, but they want to step up their game. Pretend that you are going to manage money. And you know this, Jason, because you had to do this as a CTA. You prepare a document, and in that document, it states the markets that you trade, your trading style, perhaps some general statistics as to average holding time, average drawdown, these types of metrics. And then trade that as if you are your own best client. Trade it as if I'm going to take 1 unit one unit might be one contract. It might be 5 contracts, depending on your account size. It might be 10 contracts in corn and 2 contracts in the NASDAQ. I adjust everything by a dollar range so that it's even, fairly even risk there. And say, I'm going to do a 6-month period here of my approach and style so that I can see the numbers and then go raise money on that. Okay. Maybe you have no intention of doing that. And truly, to become a CTA or a hedge fund or something is so insane with the regulatory burden and the accounting and the auditing and everything else that most people don't want to go down that road. But if you did an exercise saying, I'm going to demonstrate my style and I'm going to do it and keep these statistics, and if you really want to put the heat on yourself, show your statements every day to a friend or a colleague or a spouse or something like that. So you are fully accountable. And I think that accountability problem is really what can solve a lot of people's, ruts that they get themselves into. If they had to be accountable to somebody in some way, because, face it, you can hide your statements. Nobody sees it except you.
And you can lie about it to people too and make yourself.
Oh yeah. Oh yeah. But if you had to be accountable, it might be a whole different game changer. You might be more apt to exit a losing position at the end of the day. If you want to reestablish it the next day, you can, but at least you're not carrying this crap on your sheets overnight that's going to get you off to a bad foot the next day of trading. So there's all kinds of creative solutions that you can do. And I am not a coach, but I'm sure there are coaches out there that could, help out in that area. But you will find a way if you want.
Mr. Bill, who was your trainer.
Yes.
Record keeping is a critical part of building a good foundation. And he wasn't even talking about trading.
No.
Monitoring your statistics is also a tool that can help you stay focused and gain control over areas that are prone to distractions. It is vital for tracking performance, which is exactly what you were just saying. And I think that he was talking about your physical training, and how to be successful in that. And what I have come to the conclusion of over the years is that success in any endeavor is a formula. Whether it be success in bodybuilding, success in trading, success in relationships, it is a formula. And part of that formula is to keep records and to keep statistics and to keep honest, unbiased notes on this stuff, because that helps you an immense amount. It helped me an immense amount when I finally came to the conclusion after 10 years that whatever the hell I was doing was not getting me anywhere with this. And I had to make a decision of what I wanted to do with my life. And I decided I wanted to go on trading. I was lucky that I had been keeping statistics and trades for, a good 7-8 years. And I was able to go back through that and really see what was working and what wasn't working, and we have this faulty learning thing. I read in one book, the guy called it, where we'll remember the trade that did great, but we'll forget the 50 times we put that same type of trade on and it didn't work, right? Whereas if you're keeping the records of all that, you can go back and look and see, hey, I remember that worked great once, but it doesn't work great over time. I think that's such an important thing for people. And Mr. Bill was saying that was important for you and nothing to do with trading. So just on that subject, this was an interesting quote because I love it. You were talking about something, I think the stock market. There was excess cash on the sidelines, the number one variable in my book that drives trends. And I live that world, okay? I live in the world. My trading is all about trying to see where possible money flows are going to come from, right? If I'm looking at the COT stuff and I'm looking to short something that people are very long, it's because I'm hoping that I'm getting in front of the money flows coming out. And if I'm looking to buy something and people are very short, obviously I'm looking to get in front of the money flows that are coming in. How do you measure, because you say the number one variable in my book that drives trends. So how do you measure this idea of cash on the sidelines, excess cash on the sidelines, if you do? Or is it just a feel thing? Or
it is a big feel thing for me now because I've integrated so much like holistically over all the years. But I would say that first of all, you can look at sentiment readings. I think are huge. Okay, they're very important because if you have too much bearishness, that's people that are sitting in cash. If you have too much bullishness, they're speaking their position. So there's a modicum of that going on. You can also look at like Fred is a site that has all kinds of statistics in terms of, the data that's in money market funds and so forth. I mean, many, many years ago, there was a service called Trim Tabs that would, tell you the flows going in and out. So I'm pretty much a pure technical analyst, technician. I really don't look at news or events or macro at all. I do believe that, it'll show up in the charts and the sentiment and some of these other things. But yeah, and there's something to be said for, as Ralph Acampora put it, the broader the base, the higher into space, the broader the top, the bigger the drop, so these adages, about accumulation and distribution periods still play out. We never know for sure, because if you did, somehow it would be priced in. And there are lots of AI programs out there that incorporate these sentiment readings and so forth. And, people have put these into their models. I'm sure Ray Dalio has models that include these types of metrics. So, I don't try to, I consider those to be secondary variables. Okay. So for me, secondary factors are sentiment, seasonals, commitment of traders reports. They're like they color the market for me, leadership in the markets, group sectors. Those are all secondary factors. I'm not going to make a trading decision based off of those. I'm going to make it purely off of the technicals and the market structure. And then I just have to be confident that, for every 10 trades that I make, 2% might be big wins, or I might catch a runner. It's just a pure numbers game, as would be any game of cards. You just keep playing. And, sometimes the data is choppy and noisy and there's no volume and there's not much going on. And that's the way too with cards. Sometimes the cards are just like crummy bridge hands or something. But then there's other times where I think the biggest factor is that you have to recognize when you are dealt a good hand, and play that to the hilt. And that's, cards, baseball, markets, anything. It's really about capitalizing on those very few open doors that come across our way. And then that's where you really have to step on the gas and increase your leverage and play it to the hilt. But you can't force that. And so I find, for me, I'm not trading full time like I once was. I don't trade by any chance on the leverage that I once did. I've kind of toned things down a lot. But that was probably my greatest strength, was knowing that I got it right and to really go for it and play that. And so in the meantime, you have to keep yourself involved in a fairly structured routine ritual process, a lot of grunt work. I logged numbers at the end of the day, I didn't keep the statistics on my trades in much later years. That was more for the beginning and kind of things. But you know damn well when you're screwing up. When you're doing something you shouldn't do. I don't need to allow the trade to tell me that. I know when I've got a bias, and I recognize it. But it's just like keeping yourself. I hate to say it, for me, the markets were there, like every tick in my head, every second of the day. I just eat, sleep, breathe them. And, it's like it's in your blood. And it's not that way right now. But I mean, I've got enough residual that, that helps. I kind of diverged from our question there. But
I mean, the baseball term I use all the time is wait for the fat pitch.
there you go. Wait for that fat pitch.
And, I now, and I've done a lot of different trading in my life, but I now only wait for the fat pitch. And sometimes I'm waiting a very long time and it can be very difficult. But again, process is process, discipline is discipline. And I'll wait forever for the fat pitch if I have to, because I hate, I wait for the fat pitch and sometimes I swing and I miss anyway. Okay. But I'm okay with that. What I'm not okay, I can't hit a curveball. So when I swing and miss at a curveball, I hate it. I just can't deal with it personally. So
when you first started trading, Jason, did they have electronic execution the way they do now, or did you have to call down to the floor to your broker?
I had to call.
So I do think
I
that,
was trading before the internet, so
yes, okay. So I do think that you, me, Peter Brand, all of us had a different experience than somebody coming into the marketplace in the last 15 years. And I do feel strongly that the little mouse, and our little which does release dopamine in the brain. It is addicting. It is very addicting, and it changes your brain neurology there. It definitely does. And so, that I think is a big problem for people because it's so easy just to go in and out during the day, and it's counterproductive into the way that you're programming your brain. And I don't know what the answer is, how to get away from that, unless you had a colleague sitting next to you and you're like, okay, is this it? Yes. Is this it? Maybe trying to work through it that way. I don't know what the answer is, but I do think it's been a challenge for people coming into the markets, with this sensory stimulation. And even, my screens, the amount of data now that is coming into them is probably 50 times greater than it was, 30 years ago. I remember had a big giant satellite dish in my backyard at one point, and that got outdated, 25 years ago. So I think just being aware of these things, and once again, it's a game where that it's maybe 4% of the people will really make it.
don't overtrade is a very old trading adage, but as you say, a very difficult one, and more difficult now because of the ability to just click a mouse and have fun. My answer for that is not the only way, but the most likely way that people are going to get over that is they're going to lose enough money doing it. And eventually they're going to get sick of losing money, hopefully, and they're going to stop doing it. Okay. I think that's the only way to do it. I mean, that's the one thing about this game that personally I love is
Are you
that,
saying it's Darwinism, Jason?
yes,
Yeah.
I'm saying, we all know things that have happened in life where people have gotten lucky and made bad decisions and gotten lucky anyway, or whatever. And in this game, any individual trade, sure, but over time, you're not going to get lucky and make money in this game over time, as you very well know. And so that's what
You
teaches.
have to start off with something. That's what you and I, have to acknowledge, that somebody that's just coming into the markets in the last 2 to 3 years, you have to start off somewhere. You have to start off with a little gimmick, a little indicator, perhaps a longer term time horizon is not appropriate if you don't have that experience under your belt. Then what's more appropriate is desensitizing yourself to putting on a trade, taking it off. And because a lot of times, putting on that trade when you've got some money on the line, there's a little adrenaline rush there for people that haven't desensitized themselves, right? It's like jumping off a high dive. My heart would be pounding out of my chest. But if I've jumped off that high dive 100 times, it's not such a big deal. But, it's okay to start off with a little gimmick, a little indicator, take the pressure off of yourself to make money, keep a very short-term horizon, because it is not about calling the markets or a macro perspective or being right or wrong. It's finding one little spot where you can pick up a dollar bill off that sidewalk, and you have to then take that from there. And the other thing is, you've got all these, I don't know, Twitter and chat rooms, and I don't want to, Discord can be fine if you have a good group of people that provide the camaraderie, which is important. Camaraderie can be very important, but everybody has to learn to throttle that noise level down to a level that's not going to be a distraction for them or influence their decision-making process, which is very difficult. I'm the first, that's why I'll never have a TV in my office or listen to the news, because I know myself, it's going to influence me one way or another. I'll be like, damned if I do, damned if I don't. He already put that out there on, on the airwaves. So Yeah, so just be careful of that noise level, eliminate the distractions. It's okay to start off with a little gimmicky trade that's, oh, wow, 5 minutes, I'm in the trade. I did a little breakout of that first 15-minute range in the S&Ps and I copped two handles. Hey, pat yourself on the back, sit back for a little bit and, take the pressure off of yourself to try to do so much so soon.
Patience is a virtue.
Mm.
Understand there's a learning curve. Yes. I have two more things I want to say, because I don't want to keep you for too long. But in the midst of all this, some of these things that we've talked about, right? In terms of what I was saying about too much money on the sideline, and that's what pushes the trends. And feel free to tell me I have no idea if you'd like, but where are we
I
now?
might have no idea.
Where are we now? Right now in the markets with that? Where are we in the stock market right now?
Well, there's still a lot of money out there in the money market funds. I mean, we got up to historical levels on that money market funds. The monetary base on a global supply expanded by like 25% on a global basis. So it's hard to say how all that filters down. And there's really two classes out there. On one hand, you have your middle class and your lower class who's got, fairly maxed out on their credit cards, and inflation took a hefty dent in that. But on the other hand, the wealthy have gotten so wealthy, and there's a lot of money sitting there in money market funds. And that is increasing, because if I can sit there with my money in a fund getting 5%, out of treasuries or something, I'm just only adding to that. If you want to think about it that way, there's just increasing more and more money out there, even though we know that eventually the government will be, eating into it's always the private sector versus the public sector. So they might be, attributable to a greater percentage of the GMP than perhaps in the past. But there's still a lot of money out there. I'm not sure that valuations, have reached extremes that we've seen in the past. And I'm not a macro person,
I
but
was just going to say this is
growth
an
has been there,
incredibly, I was just going to say it's an incredibly macro talk for an intraday technical
Yeah,
trader.
I can't help it. You're still there, but I'll look at the
Yes.
charts and you could say that the weeklies are, a little rich in terms of the trend. But, even so, once we stop going up, okay, which could be, maybe we've stopped going up. Typically, you rotate and you form a prolonged trading range, okay, to digest everything. So it's pretty rare that market tops are straight up, straight down. It's much more likely that you'll have a market bottom that unfolds that way. So that to me says that we should have great trading opportunity. Don't go out there and mortgage the house to buy puts. It's not like that type of environment right now. I still think my opinion is that the VIX is still a little high. I don't get me for that, but
I
I've
love
just
it.
seen every 10 years that VIX goes down to single digits. So it is a possibility that it will go down to single digits again, which means that the implied volatility is based off of the historical volatility. And so typically at marks, the at tops, the historical volatility tends to contract. And I don't know if we have quite seen that contraction to the extreme in the historical volatility. It is coming in. You can look at bottoms and see it was so much greater. And at market bottoms, you'll see, things like market breadth plus 1800, minus 1800, plus 1800, minus 1800. And at market tops, you'll start to see, market breadth plus 300, minus 200, plus 500, this type of and that's why they always say it's complacency. It's not that it's complacency. It's just that that's the nature of the price behavior. Once it starts to reach that, point where all the funds have bought the AI stocks, and you're starting to see some rotation, right? Some
Without a
rotation.
doubt. Without a doubt.
Yeah, but that could still be a process. If we look at election years, typically, and, again, keep in mind the sample size is small here, but election years tend to hold together, so,
They
uh,
do.
but it doesn't mean that we can't have some like lovely little sell-offs along the way as well. I call them long liquidation flushes. And, my approach is pretty much one day at a time. I look at my stuff and I say, well, does this look like it's a great sell short day? Is there a little breakout coil here going on? Is this did we just have a long liquidation flush and it's a buying opportunity? And then I don't fry my brain, because I'll fry my brain if I try and look out too far in the future.
I think the idea of how markets top and markets bottom is really, really valuable, because I have been harping for a while here on people that just keep wanting to short the stock market. And I'm like, listen, you're not going to miss anything. Okay. Like you're trying to short when a market closes on new all-time highs. You don't do it. You know what I mean? It's not going to close in an all-time high, and you're going to wake up tomorrow and the S&Ps are going to be down 300 and you missed it. I've never seen that happen. Every crash I've ever seen, you traded through the 87 crash. The 87 crash, the market topped in what? August, and it crashed in October. You have time, right? And I think that's an interesting comment about how market tops, because while I have never done the quant work that you have, I have noticed that as well. They spike bottom. They don't spike top. They
I
round up.
follow a lot of the global indices too. Again, just purely on a technical basis. I'm not going to ask
Sure.
how or why, but you can't have markets like the DAX, which is still
No.
one time framing, meaning consecutive higher highs and higher lows on a daily bar chart.
Yes.
You're not going to have a sell-off in the US market as long as you have some of these other indices just going crazy. Japan's been nice. I mean, the Mexico's been nice. There's all sectors in the rest of the world where even when they stop going up, even when that DAX stops going up, it's going to rotate. It's going to form a trading range, and probably that will parallel price action in the US markets.
Yeah. I mean, my issue with all of the markets here is that I think there's been a switch personally. You know what I mean? Last year, people were so massively bearish, looking for the recession. And, I trade this sort of fade the mass psychology. Whereas now that's totally gone. Nobody can call for recession anymore. And people are bullish. I don't think that they have put all their money to work. So I don't think it's a short. But for me, and I trade on a different time frame than you, I'm picking sort of major turns and trying to catch major trends very early. I am not into being long here. I'm also not into being short here. That's just me, but neither here nor there. There's one last thing that I want to say that I read in your book that personally, your book had so many great nuggets of wisdom. And I thought this was the best one. And you put it right at the end, which I thought was apropos, because I think it is the most important thing. And this is something that I have learned. I'm now 56. This is not something that I ever would have understood when I was 30 years old. Okay. When I was 30 years old, my mantra was, I want to be a billionaire, come hell or high water. That's what I'm going for. Okay. I'm going for me. Right. But what you said here is, give, and everything you give will come back to you in tenfold. Stay humble, but remain confident. And never forget, if you don't know who you are, the markets are an expensive place to find out.
Mm-hmm.
I think that's such a great conclusion to all this, because it says nothing about markets. Well, the last part does, but give, and everything you give will come back to you tenfold. This is something I never would have believed or understood until I had some experiences with some people in my life who imparted that upon me. And I still didn't believe it. But as I've gotten older now, I have come to understand that. And I think if anybody takes anything away from any of this, that's the most, no one's going to believe it. And most young people aren't going to believe it. But I have learned, especially in the last 5 years or 10 years of my life, the more you give, the more you get. So I didn't know if you wanted to comment on that, but I just think it's such an important.
It's just all that mindset of gratitude and recognizing how lucky and fortunate and blessed we are to live in the United States where we do. And, how you choose to look at things. My mom was always one that's like, okay, you can look at it as half full or half empty, make lemons out of lemonade, all that type of stuff. And so I think by taking the rosy side of the equation, looking at positive, our blessings and so forth, that opens up your mind, to receive. And, whereas if you have, if you can't let go of things and you've got some negative energy and so forth, you'll have a block and it's just not going to flow the same way. I think that you won't be as happy of a person. And, sometimes the happiest people out there really have very simple lives. And in the long run, that's what it kind of comes down to, uh, what we choose to fill our life with. I mean, it might just be, gardening or cooking or something simple, or children or a friend. But it allows you to then proceed with your work in a more seamless type of mode, without getting stuck in ruts and blockages and why did I do that? I can't, I did that when I was younger. I mean, I'd wake up in the middle of the night and going, oh my God, I can't believe I did that. And I'd tap my husband at the time on the shoulder. I'm like, I'm so stupid. Why did I do that? And I'm like, how much negative energy did I waste? And I really think that's why I got sick for a period there as well, So we want to keep ourselves functioning optimally. First, physically, good health, nutrition, and so forth. Mentally, spiritually, whatever that may mean to you. And then I think that you will be able to perform your best in the markets because it is a performance-oriented discipline, period. It's just like going out and playing tennis or any other performance-oriented discipline. And you can't be performing well when you have, negative, cancerous energy inside of yourself. So that's my philosophy.
I love it. I love it. Words from a successful person to be listened to. Thank you so much, Linda. It's been an absolute pleasure. You are an absolute gem. Please read her book. Please listen to the things that she says about trading and about life. And I don't know, is there a place people can that you want to be found or anything like that? Or do you not want to be
I'm
found?
gonna hide under a rock, Jason. I never want to be found
Well, I
again.
don't know if you have a web
I do
page.
have a website. It's gotten greatly pared down because it was under so many cyber attacks. I probably need to redo it. But that's the only place that you can buy my book, which only has, I don't know, maybe 200 or 300 copies left. And
Hurry
then
up.
I really need to, I just, hate dealing with this stuff. I need to either sell the rights off to a publisher or stick it on Amazon or something like that. I'm probably the only person that didn't stick the book on Amazon because I'm like, they can't have 40% of my profits. I did all the work on that damn thing, And it was kind of cool. So it was fun because, and I do have an assistant who helps out with all this stuff because I just would not have the patience to deal with self-publishing. But what was super cool was that 60% of the people that purchased my book were overseas. And I subsidized the shipping. I pay for half that shipping because it's expensive to ship books overseas. But I just felt very strongly that I wanted to produce a really pretty book with the highest quality paper and the old traditional jackets. And I was willing to pay the shipping for somebody, to get it in Australia. And I don't have many copies left, but I thought that was interesting that 60% of the sales were overseas because people are so conditioned to using Amazon. They just want to go with that one click, boop, and I don't know, we'll see what happens in the future. I thought it'd be really fun to do an Audible version. It's just, God, if we had 50 hours in every day, it's one of those things. So
Yeah, I mean, I thought the world was going to end today because that thing hit that bridge in Baltimore and the Amazon warehouse is right there, and they were saying it might delay Amazon deliveries. I was like, oh my God, the world's going to end. Everyone's going to have to wait an extra 48 hours for their Amazon delivery.
I was shocked. I
How
was
are we going to live?
driving and I heard the amount of billions of dollars of trade that passed through that port. I did not realize that so many cars were delivered into that port from
Yeah.
Europe. So kind
Yeah.
of interesting.
Yeah, I mean, well,
Get your Volkswagen now. Step right
Yeah.
up, grab it off the lot.
yeah, right. Awesome. Thank you so much, Linda. I hope we keep in touch again. You're a special person, and I really appreciate your time.
Thank you for having me on your show, Jason, and just the best of success to you. And let me know next time you need some warm weather and come down to Florida, okay?
sit here every day, and I was actually looking at Florida today.
I'm looking at those bare trees in the background behind your image. I'm like, oh, that's bleak.
I know it's bleak. It's bleak up here in Rhode Island, but you know, we love it.
You like it in the summertime.
Yeah, no, I like it all the time. My wife's here. I
All
like
right.
it here. That's what she's my life. So
That's what counts. That
that's
sounds
fine.
good. All right.
All
Best
right,
to
great.
you.
Thanks. Don't go.
Bye.
Subscribe to the Crowded Market Report YouTube channel for more CMR interviews and other content from Jason.